In this video, we'll talk about a topic that I'm sure many of us have thought about, and that would be a looming economic downturn. The yield curve has begun to flatten in recent weeks, warning an impending recession. Inflation is at a 40-year high, and buying conditions are at their worst since the 1970s. We'll discuss what's currently happening, the possible impact on the overall economy, and why searches for the phrase recession have surged by 100% in the last year. In simple words, a recession is defined as 2 consecutive quarters of falling GDP, which shows that less money is spent and our economy declines. So recessions aren't always as bad as they seem. However, because GDP isn't always a reliable indicator of the overall economy, the National Bureau of Economic Research revised its definition to include a major drop in economic activity that can last anywhere from a few months to a year. This is frequently associated with decreased employment, output, and sales, which are measured monthly. We've seen 12 recessions since the 1940s, the longest lasting 18 months, and the smallest 2 months during the COVID shutdown. Since the early 1900s, the typical recession has lasted roughly 10 months. Usually, this has some catastrophic consequences. The collapse of the housing bubble in 2007 to 2009 prompted a 40% drop in the stock market, the failure of several significant banks, and the need for an $800 billion stimulus program to recover. Before that, we saw the dot-com bubble, where the Nasdaq lost 75% of its value. In 1990, we had a Gulf War recession, during which the Federal Reserve raised interest rates to assist lower inflation. But this hampered the economy, which was impacted much worse when Iraq invaded Kuwait, causing oil prices to rise. Other variables that have contributed to previous recessions include rising energy or oil costs, increased interest rates, or a shift in spending patterns. Here's what we need to be informed about. An inverted yield curve is the first. When the 2-year Treasury rate pays more than the 10-year rate, the yield curve inverts, signifying that investors are willing to take greater risk in the near term than in the long run. When this happens, it's taken as a sign that the economy is about to slow down. Even looking back in time, an inverted yield curve has properly predicted 9 recessions since 1955, with just one false positive in the 1960s when the economy slowed but did not officially enter a recession. So what's happening today is we're currently seeing a flattening yield curve, which means the 2- and 10-year treasuries are paying almost the exact same amount, while the flattening is the most extreme it's been since 2011. Overall, this is something just to be made aware of, and our yield curve has yet to invert. But this is just the beginning, because on top of that, we also have the second that we need to be made aware of. Increasing energy costs. Rising commodity prices, according to Goldman Sachs, would likely have a negative impact on consumer spending, since lower-income households will be obliged to spend a bigger portion of their income on food and gas. Furthermore, rising interest rates make it more expensive for individuals or companies to borrow money, resulting in less spending. The fact that a commodity like oil is used in practically every area of our daily life explains why high energy costs are so closely linked to a recession. When prices rise, it costs more to manufacture an item, higher shipping costs, more expensive to purchase or even travel, all of which means less money is spent. The next point to consider is the slowdown of corporate earnings. When corporations disclose their profits, they frequently provide information on their future expectations. Shareholders will have a better knowledge of anticipated profits, sales reports, estimates, and market circumstances as a result of this. However, the ratio between negative to positive guidance spiked above average for the first time. Since prior to the pandemic, companies will have a tougher time meeting earnings expectations than investors think. As a result, lower consumer spending, slower growth, and higher prices might lead to a drop in GDP, signaling the start of the long-awaited recession. This is where things become very interesting in terms of how a recession might affect the stock market. There have been 16 recessions with positive stock market returns between 1869 and 2018. Indeed, the market gained an average of 9.8% during a period when the economy fell by 3%. Or to put it another way, the stock market had practically little link with stock prices in 30 recessions. Another study indicated that the link between GDP growth and stock market prices was nearly zero at 0.05%, and on average, the stock market peaks 6 months before a recession begins. And this is where some of the bad news begins. The stock market has had a sell-off throughout every previous recession since 1945, with an average drop of 29.2%. The good news is that even if there's an abrupt sell-off by the time recession is over, the market recovers and has averaged a profit of 1.7% with an average gain of 15.3% the following year. This simply shows that investing during a recession can be one of the most profitable times to invest. Not to mention in the 3 years following, every single recession we have ever had, the market was 100% in the green. Because a recession is defined as 2 consecutive quarters of decreasing GDP, you won't realize you're in a recession until it's too late. For example, the Great Recession, which began in December 2007, was not formally recognized until December 2008, when it was nearly done. The last recession began in March 2001, but it wasn't formally labeled as one until November of that year. And this pattern has been continuous, with a 6 to 12-month lag between when a recession begins and when it is formally declared. Even while a recession may be happening now or in the near future, the greatest concern is stagflation. Stagflation is defined as a period of high inflation, high unemployment, and weak economic development, which has recently become a major worry. It happened last in the 1970s, when oil prices rose, inflation spiraled out of control, lending rates were volatile, and businesses opted to maintain their pricing while laying off people. In this case, prices went up, inflation went up, the economy went down, and it took a massive increase in interest rates to get inflation under control. The problem with this type of situation is that the solution for high inflation or low growth usually makes the other one worse. For example, raising interest rates fights inflation, but it hurts growth, and lowering rates helps growth, but it hurts inflation. Now, are you getting the point? However, it does not appear that we are reaching a dead end, and others suggest that as the United States reduces its reliance on other countries, this should no longer exert downward pressure on US prices and wages, successfully preventing stagflation. However, when looking at the similarities between prior recessions and what we're experiencing now, we can observe that the 5 primary shifts are usually 1. Sudden economic shock like the oil crisis of 1970 or the COVID crisis of 2020. 2. Excessive debt, which includes the housing crisis of 2007. 3. Asset bubbles like the 2001 dot-com crash. 4th. Inflation, which forces the Federal Reserve to raise interest rates and tighten financial growth. And 5. Deflation caused by a lack of demand for goods and services, which usually results in higher unemployment. In terms of where we are in the cycle, we are experiencing a sudden economic shock as a result of the Russian-Ukraine invasion. We are seeing the greatest inflation in 40 years, and some claim that asset bubbles are building in some of the more speculative areas of the stock market. The truth is there's no chance of predicting a recession based on market returns, and most economists have no idea we're in a recession until it's much later. Expect stock market volatility to increase, and it's always a good idea to focus on being employed. Remember that no recession has ever lasted more than 18 months, so there's hope. That's why, based on every previous recession, the smartest course of action is to remain invested. So what are your plans for investing in these turbulent times? Let us know what you think. Comment down below. If you like the video, don't forget to subscribe, click the notification bell and hit the like button. This is your Top Tech and Trades channel. Thank you for watching and see you in the next video.